Hi, this is Dr. Z, and I'm here to present to you on this snow day or snow week the Chapter 8 and Chapter 9 Google slides. So I'll go through this somewhat quickly. In class on Monday, we talked about the balance of payments as a way to organize these three chapters of 7, 8, 9, or trade, finance, and money. Why? Because the balance of payments tracks all the cash going in and out of every country. So we know from all of the 193 countries and the 193 balance of payment sheets each year what is happening in the global economy. Trade is the first half where we track where money goes. So when we export, we sell things and take money in. And when we import, we give money, send money outside borders in exchange for goods and services that come in. And remember, a deficit just means that we import more than we export, period. Finance is also about where money goes, so you track it similar to trade, except instead of goods and services, you are tracking stocks, bonds, real estate, holdings in companies, really anything that is considered an investment vehicle. The U.S. benefits from being a large recipient of foreign investment, and many economists, including myself, do recognize and argue that the U.S. enjoys the ability to have a trade deficit because of our unique position in attracting investment. So the trade deficit kind of aligns with the attractiveness to investment. And one requires the other in the case of the United States. So the final key is money, and currency and the value of money underpins the whole balance of payments. If the US dollar fell by half today, then everything in the United States that costs money based on the value of the dollar would also change immediately. The same thing goes for finance. So currency and money underpins the whole thing. So we'll talk a little bit about the introduction, types of investments, why countries invest, issues about conflicts over distribution of finance, and the role of the IMF and multinational corporations, who are the primary engine of the global economy. So one big question to think about in this week, maybe a little bit more leading into next week and Chapter 10, is about whether debt arrangements are unfair. One question is, well, what do you mean by unfair? We'll get some clarity on what we mean by fair or unfair in the global economy when we talk about Chapter 10 development. You will definitely get some clarity in the film Poverty, Inc. and hear from leaders, economists, business owners around the world in West Africa and in Caribbean about their idea of fair or unfair. And this has been a long-standing issue since the end of World War II. Lots of large, poor countries have been the recipient of loans, mostly loans, some grants, and those loans were not always granted under the same terms. So a lot of countries faced staggering amounts of debt, and debt crises have plagued the developing world really since the 1970s. So we'll talk a little bit about crises today, but this is still a big question. Are debt arrangements fair, unfair, and what do you do? So the basics of international finance: cross-border investment can improve welfare, just like trade. Financial interests tend to cooperate, so there's more cooperation when there's more investment, and financial ties do make societies mutually vulnerable, both a good and bad thing. This is why crises are usually no longer restricted to one country's economy. So let's start off and talk a little bit about the US financial crisis of 2007. Financial crises occur all over the world, and we'll talk later in regards to the International Monetary Fund about the East Asian financial crisis from 1997 that impacted a huge chunk of the global economy. The US crisis was unique in that it impacted largely wealthy countries because it was centered on the financial industry and banking, and then it turned out housing. It started really in housing, but it was the financial sector's development of new financial products, specifically the credit default swap, that led to sort of a perfect storm where large banks and financial organizations were sitting on huge amounts of toxic assets, but they didn't really know until it was too late. So I'll talk through for a second how this happened. First, there was a housing bubble. Subprime mortgages were being issued left and right. Subprime just means more risk, so low or no down payment, usually a higher interest rate, shaky credit report. Really, mortgages just got a little loose, and lenders got a little loose in who they were issuing credit to. So credit was very easy to come by, and then it all ended. It ended because of how the mortgages and the risk were packaged up. So they were packaged up in what was called credit default swaps. These swaps basically bundle all types of different financial vehicles or loans. So we're looking at credit. So it bundles up all kinds of debt. And usually in the past, debt has been clearly marked. So if you bought a bundle of debt, you would know generally what portion of that debt was risky, bad, what portion was really safe. In the case of credit default swaps, the mortgages were bundled together and then sliced up, meaning that one risky mortgage now was spread across multiple bundles of other swaps or with other types of debt. So it was very difficult and really impossible, as we now know, to identify what portion of financial vehicles were at high risk. So the financial industry was swapping, buying, and selling bundles of debt, not knowing that the risk had spread so far that many assets in the millions and millions of dollars were now toxic. And when the bills finally came due, that meant that they would not be paid. And the result was a big credit freeze. So credit had been free-flowing up to 2007. Almost anyone could get it. And then it went to the opposite, where credit was very tight. And banks actually stopped lending to one another, which exacerbates credit freezes, and it exacerbates problems with capital. Because if a bank needs to raise cash to maintain its open doors, they cannot do so unless they can borrow from other banks. The effects of the crisis in the EU were mainly around debt, although to be clear, the effects of a crisis within one country are felt differently in other countries because it depends on how closely connected other countries are to the country experiencing the crisis and in what way their economy is connected. So you can see on the screen, different countries had different experiences, and Greece is probably the most well-known, maybe Spain too, in terms of the unemployment that they faced and a backlash under their plan to use austerity. We'll also talk a little bit more in class when we get back about the austerity plans in these countries. It turns out one of the major studies that was done saying what kind of austerity policy they should adopt was based on data that had an error. So a large study by two well-known economists that put forth, this type of austerity policy will surely bring your economy back to where it was before and recover. But it turns out their findings were not as reliable or valid as they thought, but countries had already adopted their recommendations. And again, I'll talk a little bit more about that when we get back. So this link shows you a little bit about the other impacts around the world. And just scrolling down, you can see Cote d'Ivoire experienced issues because of commodity prices. Remittances were low. Remittances are money that is sent back from people who are working in other countries. So if someone from Nigeria goes to Spain and sends money from their job in Spain back to Nigeria, it's captured in what we call remittances. And some developing countries rely quite a bit on remittances. And you too may have sent back money to your family in another country. So you have participated in sending remittances. It's just a word to capture money that flows across through families. So types of investments. The first is foreign direct investment. This is where the investor has over 10% of control over whatever they invest in. So if a company opens a factory abroad and they have at least a 10% stake in that new factory, then that is called FDI. And I did give you links to Investopedia's library or glossary. Investopedia is a pretty good resource for learning economic terms. You can see it's filled with ads, but generally it has pretty basic explanations of what a lot of these things are. So you can see FDI, investment made by a company or individual in one country in business interest in another country. And you can read a little bit more down here and look at some of the data. So total FDI into U.S. businesses in 2016 was $373.4 billion. So that is the money that we benefit from when other people outside the U.S. invest in the U.S. So we enjoy $373.4 billion of investments. So the second type is called portfolio. This is basically everything else where the investor has no role in management. So if you buy and sell stocks and bonds, really, again, everything else is captured under portfolio. So why do countries invest and borrow abroad, especially if the risk is larger when you have more capital flowing across borders? You can see this data shows FDI in emerging markets and the difference between FDI in the light blue, bonds and loans in medium blue, and equity in this dark teal. So those are just the different types gathered by the World Bank. And wow, look how interdependent the global economy has become. Since 1970, that's a couple decades after the UN was formed, kind of exploded in the 1990s and then definitely in the 2000s. So while this potentially benefits more people, it also makes everyone mutually vulnerable, and that's why the stake of crises has increased so much over the last couple decades. So, the cost of investing abroad usually is going to depend on the country. So, for example, Argentina has laws. If you invest in Argentina, you cannot take a lot of your profit, if it's in Argentine dollars, out of the country. So countries have different rules that are called capital controls, and they limit sometimes, again, how much of your profits can come in and out. They have different rules about how foreign investors can operate, what kind of real estate they can buy. The United States has limits too. We talked a little bit about, why you might not want a port to be controlled by a foreign entity. Well, that's a limit on foreign investment. So this is just demonstrative of the appeal of the U.S. to the rest of the world as a financial center, but really as a large market. So this is FDI to developing countries. You can see it actually was quite high. Or it is quite high rather now. So it still does not reach, though. If you look at this graph, it doesn't even reach 50%. So on the left, it's 45% of total FDI. So there's still today more FDI going to wealthy countries. Again, the US is one of the top attractors of FDI worldwide. The EU is too, and as you might guess, China has increased. But FDI in the 1970s, only 15, well, about 7.5 up to 20-something% was flowing into poor countries. Now it's gotten a lot better. It's over 40%. As of the last year, this was accessed in 2014. But the developing world not benefiting as much from flows of investments as the wealthy world. So let's talk about distributional conflicts. The terms of the investment matter. Are the interest rates matching the type of investment? Is it a soft loan, a hard loan? A hard loan is usually a short period of time, higher interest, and there's not a lot of concession if you are late on your loan. Kind of like if you want to buy a car and you go to a shady car dealer, you're not going to get as good of a loan. The terms of your investment are not going to be as good as if you had high credit, you went to a reputable bank, maybe you got a deal for 0% interest. That's a good term of investment for you buying a car. But because of your situation, you may not be able to benefit from the same terms as other people that have a different situation. Conflicts within a borrowing country. So foreign capital may be fickle. This means that when foreign capital comes into a country, so if a US multinational invests in Bangladesh, they're going to pull out of Bangladesh if they foresee any big risk to that investment. And that means that workers may be left high and dry. So if a call center in Bangalore, India suddenly closes because the wages in Bangalore, India went up and the multinational running that call center moved it to the Philippines, then Bangalore, India is impacted and they will just have less employment. Foreign capital inflows benefit more than others. So if you in your country are an owner and you get the benefit of the investment, great. If you are not, then you really won't see a lot of the benefit. So the structure of a country's economy will determine how you see or benefit from capital inflows. And when the government borrows, who should sacrifice? This is a big question. If a government borrows $200 million from the IMF, they're going to have to repay that. And one of the primary ways that governments raise money to pay debt is through taxes. So you do have to keep in mind about countries borrowing and foreign capital, that it is often individual people, especially in developing countries, who end up paying long-term bills on those loans. So it's really critical that when countries get a huge influx of loans, that it does provide things like better infrastructure, more education, and it actually improves the economy on the ground, allowing them to have the capacity to repay the loan in the future. This is what has led to a lot of problems in countries that have squandered loans or straight up stolen loans. The loans have not been used to benefit the economy at all, or just to some degree. And then when the bill is due, the country raises taxes on its citizens, but it had not provided any opportunity for citizens to increase their income to offset that tax bill. So you can see it's a terrible situation long-term for many people in developing countries. So this is a big question about the U.S. dependence on foreign capital. This is a very famous poster, "We the people are now owned by the Chinese." What this references is the fact that China has been a big investor in the United States. So they have bought bonds, they have bought other types of investments, and you hear sometimes the rhetoric of, well, if they wanted to call in the debt, then they could. But the fact of the matter is that when a country like China buys bonds, the terms of those bonds are very clear and transparent. China is not and can't tomorrow say, oh, we want to exchange all of our bonds back for US dollars. That would be a violation of the terms of the original investment. So you do have to be careful with some of this rhetoric and look beyond the superficial statements that are made without an understanding of what the investment vehicles are all about. And again, it's about the terms of the investment. That's really critical to understand before you can think about the relationship and the mutual dependence. I will say, to be fair, I always like to say that the US and China are codependent. If you know anything about codependency, this is not necessarily a good thing. But in the global economy, we enjoy a lot of imports from China, although that has declined a little bit as we've gotten more imports from other countries. And they enjoy being able to invest in the US economy. So it's a mutually beneficial codependent relationship. So this issue of moral hazards is really important to understand when you think about foreign capital. Insurance is when someone else pays if you get in trouble. Insurance in finance is bailouts and loans. Moral hazard refers to the fact that if you know you're going to get a bailout, you are likely to behave differently and usually badly. So if you get a $500 loan from, I don't know, parents, significant other, or you win a lotto ticket for $500, are you going to spend that $500 in the same way as if it was $500 from your own paycheck? We sort of have this conversation at a personal level when we say things like, oh, it was found money. I didn't have it before, so maybe I'll do something with it that I would not have done with my own money. The same thing works at the country level. So moral hazard in the global system can be dangerous because it means that countries can behave badly when they know that a bailout is on its way. Multinational corporations, and this is why there's a big debate, or was a big debate, about the bailout for the financial crisis. If we bail them out, they're going to expect it. That is true to some extent, and behavioral economics research has shown that people do fall prey to behaving differently with moral hazard. The solutions to moral hazard are regulation and monitoring. So if you regulate behavior in the global economy, then you can limit the impact of moral hazard. And if you better monitor behavior in the economy, then you can avoid it out front. So if you know that banks, for instance, if regulators knew that credit default swaps before 2007 were spreading toxic assets across the entire financial system, had that been flagged, then we would not have been, or banks would not have been in the same situation of having to rely on bailouts. To be fair and clear, not all banks needed a bailout in the financial crisis. Several really did, though. So an example, and the next few slides go through examples in the United States. The Great Depression had the stock market crash in 1929, and then bank runs from 31 to 32. The FDIC was created in 1933 after the Depression, a result of it, and it provides insurance against bank failure, but it's for only institutions that take deposits. So it does not cover your investment vehicles. The savings and loans crisis in the 1980s, this figure demonstrates what happens when a bank knows that it's insolvent. It will either declare bankruptcy and say, yep, we behaved badly and we need to apply for an FDIC bailout. Or, unfortunately, this is what happened in the late 1980s, they make a bunch of very risky loans that will be really lucrative if they pay off. So it's a little bit of a gambler's fallacy at play here. And then the loans go bust. They still are bankrupt, and get an FDIC bailout, or the loans pay off and they live the high life. Which of these two options is going to be more likely? The second one, thereby increasing the risk, because banks know either way they get an FDIC bailout. And here, if they make the risky option or risky decision, they might benefit from living the high life or making a lot more money on their risky loans. New financial instruments like the credit default swaps are largely unregulated, no safeguards, and no insurance. One thing I want to be clear, this middle point has hedge funds listed. Hedge funds were not the reason that the 2007 financial crisis happened. It really was credit default swaps that were largely made by big banks. And then on the regulator side, the regulators' inability to identify the risk that had spread across the whole system. Hedge funds, however, are smaller, and they're pretty transparent about their risk. There is no hiding. If you invest with a hedge fund, you usually have to have a lot of money, which raises questions about the access to credit for people outside the top 1%. But people know what they're getting into with hedge funds. So they were not the primary reason that the 2007 financial crisis happened. They are just another new instrument. So the role of the IMF. The IMF was created as a lender of last resort. So the IMF is the insurance for the global economy, and they are the lender of last resort. This serves the same function as Britain in the 19th century. So their primary mandate is financial stability. They do so by checking balance of payments of every country every year. And between the years of 1948 and 1971 and 3, their other job was to stabilize the exchange rates for currency. And we'll talk a little bit more about that in the next chapter. But that's their main job. IMF, financial stability, and they do that by being a lender of last resort. After 1971 and 1973, they went from an insurance institution into their own type of financial power. And after this happened, they started to introduce what's called structural adjustment. Structural adjustment reflected a set of policies that was developed by the United States, mainly US, but also Europe, and it can be captured by what's called the Washington Consensus. It was a set of policies like privatize your utilities, lots of things like that, that were given as terms or conditions or strings to all IMF loans. They've been deeply criticized by the Global South. So if you Google structural adjustment IMF, you will find a lot of history about structural adjustment itself, but also the criticism by the Global South. And structural adjustment conditions or terms attached to loans in Thailand and in other parts of East Asia were responsible for the 1997 East Asian financial crisis. And again, to recap, the structural adjustment program was basically a set of loans or terms or conditions attached to all IMF loans. So if a country wanted to get a loan of last resort from the IMF would say, oh, that's great, except you're going to have to adopt these 6 policies or these 10 policies and do so at this time period. Part of structural adjustment was also forcing countries to move their currency from a fixed currency to a floating currency. So the IMF really would tell them to do lots of things with their economy, including what type of currency they should have. So that's the image of, actually, I think this is the Thai baht down there in the right-hand corner. I could be wrong about that. So it was Thailand where the East Asian financial crisis happened, and in one day, the currency was brought from a fixed to a floating currency per IMF string or condition. And then the crisis spread like wildfire and turned into a 6 to 10 year economic crisis for most of them. So one really interesting thing about the IMF is the voting power. Power in the IMF is not equally distributed. Power in the IMF, and whoops, I'm going to actually exit and show you what this looks like. We would have done this had we had class. So I'm looking up IMF voting power, and we're going to go look directly. Okay, so this screen shows you. So this screen shows you okay, back to this page. Sorry about the interruption there. So the IMF voting power looks similar to the United Nations. Every country in the UN system is a member, and they vote and make decisions, and the weight of their decisions is dependent on their voting power. So I will scroll down. So you can see on the right-hand column the votes, and then number percent of total. So we're looking here at the percent of total. So Afghanistan has only 0.09% of voting power in the IMF. I'm actually going to jump down. So you can see it adds up to 100%. I'm going to jump up. So here is the voting power for the United States, Japan, China, etc. The United States has 16.52% voting power. This is critical to understand. Major decisions at the IMF require an 85% voting majority. This includes things like changes to the original charter. Most loan decisions are only 50%, but any major change requires an 85% majority, and the US has a de facto veto power at the IMF. This percent is reliant on how much capital it pledges to the IMF. So in exchange for the capital that it provides the IMF, it gets a veto power at the head of the IMF. Next, you can see Japan has the next highest power, followed by China. And then Germany has a lot of power too. And there are other countries down here. France and the United Kingdom have their own power. Further complicating this, you can see this with this voting group. This group of countries does not get to cast their own ballot. They get to cast one vote for all of them. And that one vote is worth 4.34%. So Malaysia does not have its own voting power at the IMF. It is subject to these two people up here who make the decision in the IMF for all of these countries. And let me scroll down here. This particular group, look how much voting power Italy has compared to these other countries. So to elect these two people, they cast their ballot, and the ballots are weighted according to these numbers. So when Italy votes for who they want to represent Italy and these other 5 countries at the IMF, they get 152,000 out of 207,000. So they obviously have a majority, and they usually vote for their own person to lead their voting group. So Portugal, usually subject to whoever Italy votes for. San Marino, definitely subject to whoever Italy votes for. So this is often not talked about, but a really important part of understanding the IMF, the fact that countries do not have an equal share, and wealthy countries really do have a ton of power to determine the role of the IMF, which also means shape the entire global economy. So the benefits of the IMF, you get technical expertise. They can facilitate agreements that would otherwise be very difficult as the lender of last resort. And the criticisms, I say, where do I begin? My own research has been critical of the IMF and the World Bank, so I want you to be aware of my perspective, and it's shared by a lot of economists. So this is the laundry list of criticisms. So their financial standards and advice have been largely from the experience of Western Europe, the United States. They've not had a good record in preventing crises, and in fact, they've caused some. Their negotiations are non-democratic, and they force non-economic policy changes. And finally, and not least, they do ignore, largely, human rights and environmental standards issues. So this is a famous criticism of the IMF that they've, the World Bank too, to be fair, that they have spearheaded projects like large dams and created reservoirs. Well, people used to live here. This is the lack of human rights and environmental standards. So many dams that have been built have been terrible in terms of how the people who have been kicked off their land have been compensated, if at all, assistance for relocation, for employment opportunities. And then many of these dams and hydroelectric power facilities have not generated nearly as much power as hoped. And this largely had to do with infrastructure and access. So sometimes the dams were built in a place where it just might not have been able to benefit the rest of the country. Finally, last but not least, multinationals. So multinationals are the vehicles for foreign direct investment. And these are just different types of foreign direct investment. Greenfield investment is building a new factory. They can merge, they can acquire other businesses, or go into joint ventures. So multinationals are the big engine behind all of the capital flows across the global economy. So why and where? Market access, natural resources, financial conditions, etc. These are all the things that multinationals take into consideration when they are deciding whether to invest abroad. So does it give them more access to a market? Do they get more natural resources? What are the costs going to end up? Like, is it going to reduce their labor costs? Is it not? So basically, it's actually a pretty long process, I'll be honest. Multinationals will only go where it makes sense. And it's not just cost, to be clear. It is a combination of a lot of different considerations. So Nike in Vietnam is one of the better known cases from the 1980s about Nike taking advantage of cheap labor, using sweatshops. And to sum up and to link back to foreign investment, nearly 75% of FDI is among wealthy countries. So while this is usually the face of foreign direct investment, it's usually the Waldorf Astoria who's receiving investment from abroad. There is a lot of investment in cheap labor, but there's more investment that actually goes to wealthier countries. It's a little bit of a myth of foreign investment. Why do countries want foreign investment? It's a less risky source than loans, and it creates jobs. So developing countries are often competing with each other, trying to get investment from abroad because they benefit from investment in a way that they do not from loans. There are spillover effects. So capacity building refers to, so if a multinational moves into I'll just pick like Johannesburg, South Africa. They're going to do things like train. They're going to do things like work with local high schools, local universities. They're going to do things like build a road, build bridges. So the capacity refers to the capacity of the country to grow their economy. And they also benefit from the technology transfer. So if in that investment in Johannesburg, let's say it's a software company, and they're going to be building new chips in Johannesburg, South Africa, to try to compete with companies building in South Korea, Japan, and China. Well, now South Africa is going to be able to potentially benefit in the long run from having access to that chip technology. Issues with FDI: foreign direct investment is not a development panacea. If a country receives investment, it's not a magical unicorn to make everyone better off. Capital is more mobile than labor. This means that if this company in South Africa wants to build better chips in Johannesburg and they try to do it for a year and then it doesn't work out the way that they wanted to, they just leave. And this is because capital is more mobile. If they leave, the workers are in South Africa. And if they have workers that came with them from their home country, they're going to leave and go to the next country. So capital is very fickle. Regulating FDI. There are international institutions that deal with FDI, but the second bullet point, it is not deeply regulated. These are some examples of how they're regulated, which are above and beyond the scope of this class. This last link brings you to a Guardian video, and I'll let you watch this on your own. It is somewhat long, 6 minutes, but it talks a little bit about the ICSID court and how companies can sue countries to back up the terms of investment. There's been a lot of controversy over that, and I can talk more about that with Chapter 10. Some of the controversy is warranted. Some of it is not. So this is the court system, again, ICSID, where companies can sue countries. So summing up, within nations, some people benefit from access to capital. Others resent the constraints and burdens that foreign investors impose. And then internationally, creditors and debtors can conflict. Lenders, borrowers, investors, and recipients of capital bargain over debt repayments and profits for multinationals. So it's an opportunity for more bargaining, with each party seeking a better deal. And international institutions can structure interactions of countries in the global economy, but their role is controversial. And here's Jamaica looking to the IMF. This is another famous failure of the IMF. Jamaica in the 1980s and 1990s thought that the IMF was going to take them out of their shaky economy, and it actually made them worse off. And I can answer questions about that in our next class session. So I'm going to hop on over to Chapter 9. This is actually going to be really short because money underpins the global economy. But a lot of what we just talked about with the IMF, with capital, you actually already know a lot about money. So money underpins the financial system. So first, I'm going to talk about money's social functions, and then a little bit about the exchange rate regimes, basically what money does, and then options that countries have today for choosing how they're going to run their currency. Is it going to be fixed, floating, a dollar? And I'll define all those options in a moment. There is a bit of a historical section I'm going to gloss over and leave you to study that on your own to make this a lot shorter. So here's money in pop culture. Lots of songs, lots of movies have been written about money, as you well know.
Money, 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 money. Money, money, money. Money, 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 money.
All right, I'll let you go back to those and listen to the full songs. So, within countries, there's often conflict over monetary policies. Why? Monetary policies change the entire economy. Among countries, monetary relations are central to a stable global economy, and monetary institutions, that's the IMF, can facilitate interaction. So we're still working with the IMF here. So let's talk a little bit about money. The social role of money is really important to consider. Money is a medium of exchange, it stores value, it's a unit of account, and its value is determined by lots of different things that fall outside the scope of economics. So it can be difficult to study money without fully appreciating the social interaction or social aspect of money. Which leads me to talk about what the options are for countries to decide what to do with their currency. So the social relationship of a community or country to their money can shape what option they pick. So the three options highlighted here are all called exchange rate regimes. That's a fancy term for how a country is going to determine its currency value. The first, more popular option today is the float. This is where your money is determined by the market. And I'll quickly jump out and demonstrate what that looks like. Sorry, this is taking so long. Okay, so I'm just going to do this short Google version. So I'm going to, we could come back at the end of this talk and check this. It's probably not going to change too much for Google, but you can go to any one of these websites to see. This one, it looks like they are going to update. So they're updating maybe by the day. But if you go to other investment sites, you'll see it updated by the second. So a float means that the value, there we go, just changed. The value of the euro, the pound, everything else is determined by how much it's bought and sold. So countries and people and companies and travelers can go and buy and sell currency just like you would buy and sell a commodity like steel. And that changes the value of money. The float can be risky, but it has been generally considered the option that's best for a lot of large, well-functioning economies. The pegged option means that it's set to a specific amount or range. This is the Chinese yuan. So the yuan is pegged to a certain range of the US dollar, and it's controlled by the government. And pegged is actually common too. A lot of developing or small countries will choose this option. And it essentially allows them to stabilize their currency. So replacing one currency with another, dollarizing is a term when countries like Ecuador adopt the US dollar as its primary currency. They did so within the last 10 years. Other countries have done so in the last 20 to 30 years. And what they do is basically say, on this date, we are going to no longer use this currency, and then they'll give a deadline like a year after that, 2 years after that, and say, you have until this deadline to hand in your old currency at this conversion rate. That's what happened when the euro was started. So the euro was issued, and then everyone had a certain time period to exchange their old currency for a set amount of euro. So the euro had a 1 to 2 year not trial, but initial period. So this is the map of all the different exchange rate regimes, where you can see the floating, the fixed peg, and then the fixed rate. And this is just for half, obviously, of the world, but it gives you an idea of just in this half, the variety of different options that countries can make. Here's the other half. Even more variety. So currency values respond to all kinds of things. Interest rates, the current account, that's the trade account for balance of payments, the price of your major exports, and any instability. So the US is an anchor currency and has been so really since World War II, but in the floating market since about 1973. All states maintain the value of their currency through intervention. I want to be clear, China is not the only one intervening in their currency. The US does it, Mexico does it, everyone does it. Countries have, as a primary strategy, in fact, monetary policy to make sure that their economy remains stable. So countries often maintain power or control over monetary policy. Reevaluation is when the country adopts a new higher value, and devaluation is where it's a new lower value. So the US in gold is one question that I'll address in a moment, but that's your image. Value of the currency in the short term means that there are undervalued and overvalued currencies. In a floating currency system, there will always be some that are slightly undervalued and some that are slightly overvalued. It is impossible to have them all at their quote-unquote appropriate value at all times. So with so many options, how do states choose? To be clear, there is no single right way to determine the appropriate currency regime. There's a snapshot of all the different values that you usually see when you get off the plane in another country. So who favors fixed or pegged rates? Investors, borrowers, people who trade, and people concerned about inflation. There are very good reasons to have a fixed or peg exchange rate. This is why China has it. This is why lots of other countries have it. It is more stable, period. Who favors floating? Industries that compete abroad and countries that have fewer links to the global economy. Floating has been the option that most major economies have chosen, as I said before. It is the option that has the most risk, though. So arguments about what China should do about its currency are often couched in an understanding of how the float works for your own country. But the floating currency needs to be aligned with the structure of the country's economy. Or, as we saw in Thailand with the East Asian financial crisis, if countries are not equipped or aren't ready for a floating market, then their currency is going to be subject to crashing, sometimes overnight, drastically altering their economy and pushing them into crisis. So I want to be clear that you understand that the floating is risky and that it has been risky for countries that have switched. And there are good reasons to question whether a floating currency is the right choice for all economies. So how should states determine? They basically go with this. They say, okay, which one is better than the other and which one is weaker than the other. There is no perfect option. There's risk with all of the options, and they just have to go with the one that is stronger for them relative to others. Currency choices impact trade a lot. And then here's the quick history. So When we look at what history tells us about money, we can look at how it impacts A, an individual country, and B, the entire economy. The gold standard went for this time period. We did try it again, and I'll talk about that in a minute. But the tenets of the gold standard are pretty clear. You set the currency to a specific dollar amount. Banks must guarantee 100% convertibility, meaning that if you have gold in your house and you bring it to the bank, they must give you at that point the dollars that match your gold, and you should always be able to cash in your dollars for gold too. Total wealth is tied to the amount of gold, but to be clear, reserve ratios tell you how much money in this time period was backed by gold. So some countries only had 41%, it went all the way up to 80%. So countries did not have like all their money tied to the amount of gold. It was usually more than 50%, but it's not 100. So leading financial centers cooperated during this time period, but the burden fell on the politically weak. And then we get to the gold standard controversy. In the 1890s, the US went into recession, there was a railroad strike, and then William Jennings Bryan made the case for going off the gold standard because it was not working out so well for the United States. In fact, the United States pitched a plan in Congress to go with a silver standard because as Western expansion was happening, the US discovered quickly that it had a pretty big silver reserve. But that was obviously a failed attempt because you do not know much about the silver standard unless you study U.S. history. The gold standard controversy can be seen in this gem of a film. And then when World War I hit, the monetary system basically went into a free fall. So there were floating exchange rates. There were devaluations, warring currencies. The global economy was in shambles. And if you know anything from our trade chapter, the interwar period, trade barriers were being put up left and right as well. So trade barriers skyrocketed, currencies were floating on what's called a dirty float. They were freely fluctuating, flying all over the place, leading to a lot of instability. And it's actually, to be clear, this instability, both in trade, finance, and now currency, is what is attributed to the rise of fascism in Europe, not just in Germany, most well known with the rise of Hitler in what was then a democratic society. But poor, unstable economic systems do often create conditions for the rise of conservative parties and nationalism. And nationalism, if you recall from earlier in the semester, led out to its full extreme, is fascism. So the rise of Hitler is a lot of an international political economy story, not just about politics. So in this time period, there was an attempt for 5 years to go back to the gold standard. Britain tried it. The US kind of did too, but they didn't really do it that well. They picked a bad value, there was inflation, and the banks just couldn't sustain the convertibility requirement. They were not able to give people gold for the money that they were told was equal to a certain amount of gold, and it crumbled. And that's the date, of course, of the Great Depression. So early international coordination, there's a snapshot there, focused on trying to make sure that the financial system was stable. Bretton Woods is the answer to that question. And as you just learned with finance, the IMF is in control over currencies and exchange rates in this time period. The IMF helped countries determine the right value of their money based on balance of payments. So they would literally look at the country's balance of payments and say, oh, looks like you're a little off. you need to increase the value of your currency or decrease the value of your currency for the next year. All the currencies were pegged to a specific amount of the US dollar, making the US dollar the official anchor currency. I cannot overstate enough the impact that the US had on the Bretton Woods institutions. I already talked about the US power in the International Monetary Fund. It has the most voting power by far, but it also orchestrated the IMF, the World Bank, and the GATT and the WTO in such a way to make sure that the US dollar was the anchor currency, but was the center of the entire global economy. The managed float is basically our current system. Nixon brought the US off the value of gold in 1971, and then the US became what is called a floating fiat currency. A fiat currency just means that the money, like it's just paper. It's not worth anything. You could rip it up, and you wouldn't lose any inherent value because the paper doesn't carry the value. The fiat currency just means that it carries value that people determine. The currency markets flourished, and that worked to change the value of money second by second. So here's a snapshot of how currency influences the economy. So this is from 2012, and you can see up here loans in foreign currency. So this is the percent of loans that they received in foreign currency, the depreciation of their national currency. So Lithuania and Estonia had 0 depreciation. Poland had 43% depreciation. And then the real GDP growth rate, and then the change in unemployment. This is really just to show you money matters and it influences all of these things. So this is European integration. This is a good snapshot showing you of what has happened. And to be sure, this is European integration for the euro. So you can see Great Britain is not in here as of 2015 because they did not go with the euro. So this map may be a little confusing. It does not align with EU membership. It is just members of the EMU, or the common currency. And finally, currency collapses. They occur when commitments to back the value of a currency are no longer credible. So when people from the outside say, you know, your currency is not as valuable as you say it is, and we're going to challenge you. Who gains, who loses? It really depends on the makeup of the country. Here's an example of a currency crisis and protest. Speculative attacks have been way more frequent. So when a currency looks unstable, banks will attack and swarm like cockroaches in a New York City subway. They will smell any kind of instability and then try to essentially make a profit off of buying and selling. And they will do speculative attacks to see if the currency is stable or powerful enough to stave off the speculative attacks. If it's not, they will keep going. So international cooperation, benefits, costs. I'm actually going to go right through that. To sum up, currency policies generate conflict. Values are the product of interaction. Countries often disagree. And monetary institutions like the IMF can create rules to promote cooperation. Thank you, and I'll see you next week.